Welcome to Accounting 401, Auditing. This lecture provides the introduction into the class and covers the first chapter of our textbook. The topic of this class is to define the origins of the demand for auditing and assurance services. Let's first begin by reviewing the quote at the very first slide in our class. The quote is from James Doty, who is the chairman of an organization called Public Companies Accounting Oversight Board, which is primary regulator or auditors of publicly held companies in the United States. So what does James Doty say? Our system of capital formation relies upon the confidence of millions of savers to invest in companies. The auditor's opinion is critical to that trust. As you may infer from this quote, the auditor's role is the ultimate protector of public trust. The auditors are there to ensure that investors' investments are protected and we have good flow of capital in the capital markets. Where does the origin of demand for auditing come from? Let's first talk about the basic economics problem, also known as the agency problem, which is defined by the inherent conflict that exists between investors and managers. And by managers, I mean the executives of the company, the employees of the company, whoever is over there to ensure that investors get their return. Investors delegate their resources in the form of their money, which they pay for stocks and bonds of companies, to managers so that managers would manage those money for them, effectively by investing those money in the value increasing projects. But nothing really prevents managers, absent any other controls or institutions, from just basically running away with that money or stealing it or using it for things that investors don't want them to use them. For example, paying for their expensive corporate jets or going on expensive vacations instead of actually investing it for investors' benefit. So the basic solution to this agency problem, which is also, there is a term called separation of ownership and control, namely separation of ownership means that investors are separated from managers who actually manage the company on a day-to-day basis. Investors do not control managers on a day-to-day basis, and therefore are unable on a day-to-day basis monitor how managers monitor their investments, manage their investments. So the solution to this problem is to actually require managers to periodically report to investors on how well the company is doing. So if the company is doing poorly, investors can sell their stocks, can demand repayment on their bonds, and so on. Managers have to provide investors with that information. But fundamentally, nothing also prevents managers from providing information which is not true. They can quote-unquote cook books, a term you've heard before many times. So therefore, you need an independent and competent third party to certify that information that managers provide to investors is in fact correct. And that's where the auditors come from. That's where the demand for auditing comes from. Auditors are that independent third party which is there to ensure that the information that is provided to investors by managers is in fact correct. Another reason why we need periodic reporting is because we want to also structure contracts with managers so that they're incentivized to actually work well instead of waste investors' money. For example, we want their pay to be performance-based. We want managers to be paid when they work hard and not be paid when they don't work hard. But how do we know when they work hard? Well, that is when the company is doing well. So therefore, investors want to know when the company is doing well, when the company is doing poorly. So therefore, we have the need for periodic reporting. And again, how do we know that the managers who ultimately furnish those reports do not lie to us? Therefore, you need the auditors who would certify that the information provided in the manager's reports to investors is in fact correct. Therefore, the origin of auditing goes back a long time ago. Some would even say back to the 13th century. But the development of the auditing profession, that really as we know it today, goes back to the 18th century, when the first joint stock companies like East Indies Company or West Indies companies show up. These are the first modern corporations, which really have this feature of dispersed ownership, that has many, many investors, that each one of them cannot on a day-to-day basis participate in the management of the company. And therefore, they need to hire managers to manage the company for them. And that creates a real first problem with the separation of ownership and control, where investors manage the company on a day-to-day basis. Investors really do not get themselves involved very actively in the management affairs. So that creates, of course, the need to report on how well the company is done, and of course has the need for creates the need for auditors. And we see the emergence of modern auditors right about the late 18th, early 19th century in the United Kingdom. The development of the accounting profession as we know it today probably goes back to late 19th century, early 20th century, with the emergence of the public accounting firms such as Price Waterhouse. So basically, the auditing profession has been out there for as long as the capital markets, as we know them today, has been out there, because it's such an integral part of the functioning of the capital markets in the world today. So as I already said, the basic demand for auditing comes from the need for an independent and competent third party to certify that information that the managers provide is correct. And this third party is an auditor, or more precisely, an audit firm. Or it could be also an individual practitioner, individual CPA, which is now much more rare than it used to be. What does it mean to be independent? Fundamentally, it means that the auditors are not influenced by management. More importantly, it means that the auditors have no incentive to bias their report to curry favor with management. For example, one of the more specific meanings of the word independent as it applies to auditors is that the auditors cannot own any stock in the company they audit. Why is that? Well, that's because suppose that the auditors find out that the company is doing poorly and the management does not want to say it to the investors. They want to lie. So if the auditors have investments in that company, they may hesitate to force management to disclose that bad news, because if the management discloses that bad news, the company stock will go down and the auditor's investment value is also going to go down. So we want to make sure that the auditor has no conflict of interests that would prevent them to actually force truthful reporting by management. In other words, we don't want the auditors to be bribed into compliance with management. It doesn't just apply to the stock ownership of bond ownership situations. We also don't want the auditor to be closely related to management. For example, we don't want an auditor to audit the company where their spouse is the CEO. It does create potential conflicts of interest. Not to necessarily say that it's always the case that just because you have a spouse who is your client that you will violate something or you can be bribed or anything like that. But that's an example of not just independence in fact, but independence in appearance. And that's a term, independence in fact versus independence in appearance. You may in fact be independent because you may not be completely influenced by your spouse at all, or your spouse knows not to interfere with your duties as an auditor. But it may appear that, in fact, you're not independent to somebody from the outside. So therefore, such situations are also undesirable. What does it mean to be competent? Well, on a very basic level, the auditor knows what he's checking, right? The auditor's role is to check accounting, to make sure that the accounting is right. So it means that the auditor has the right kind of education, has a CPA. CPA is the basic certification that suggests that the auditor has the competence level necessary for conducting audits. And by the way, anybody who is a manager or partner in a public accounting firm has to be a CPA if they want to be in the audit practice. Because the basic right that the CPA has, that nobody else has, is the right to sign audit opinion. Any audit staff or anybody below a manager or partner in the firm does not have that right. More broadly, want to be the auditor needs to be an expert in the client that they're auditing. I don't mean just one auditor. I'm talking about the whole firm or the audit team in this particular context. Just like you would want a surgeon who is competent in doing particular kind of surgery, and you want the auditor that also specializes in particular kinds of clients. For example, banking is a very difficult area in terms of their accounting. It's very complicated. It's subject to not just GAAP rules, but many regulatory rules. So not every auditor is capable of doing the audit of a bank well. So you want an auditor who is well familiar with banking accounting rules and all of the specifics inherent into the banking industry. So that's just with respect to competence. Also, we want an auditor who follows the basic rules of how to do audits. They exercise their responsibilities with what's called due care and follow professional standards. Just like in any profession, it's not simply enough to be competent. It's not simple enough to be an expert. You also have to do your job right. A surgeon might be educated well and doing surgery, but if they are negligent or sloppy in doing their work, then it's not really enough that they just have the knowledge and ability to do the work. It's how they exercise the work. Do they follow the rules? Do they follow standards of care? Are they sloppy in their work? So just for that reason as well, the auditor is not enough for the auditor to simply just be an expert in their field, but also they have to follow basic standards of care, namely the auditing standards, which we'll talk about extensively in the course of this class. Finally, what does it mean to certify? Certify means for the auditors are responsible to deliver a report in the end of their audit, which would suggest whether the financial statements are in fact quote unquote correct. That report, that whether the report is clean. Clean in this, it's actually a term people use, meaning that it suggests that you can rely on financial statements. A very important feature of that certification process is that the auditor has to be liable for providing a report which is untruthful. We don't want the auditor to give a good report when in fact the client deserves the bad report. If the auditor does so, they need to be liable under law for violating rules of their profession. So the concept of certification implies that the auditor has a stake in the game, that they won't just always say that everything is fine, that if they say that something is fine and it in fact is not fine, that there are consequences for the auditor. And that's important because investors want to know that if the auditor does something wrong, namely gives a report on of a good company on a bad company, that there will be consequences, or else they will not trust the auditor's report because they will know that the auditor is probably lying and it's just not good information. So what is the role of information in this business in general? The auditors are there to assure us that information, namely the accounting information that their clients, i.e. the companies, deliver to investors is in fact true. But to these days it's getting more and more difficult because information gets more and more complex. And it's not because somebody is necessarily manipulating the information, but because business environment is getting more complex. Whenever you have complex information environment, there is always an increased risk that your information system will deliver a wrong report. So, that gives a rise to this notion of information risk that investors price when they buy stocks and bonds of companies. And broadly speaking, it means that investors will pay less for the company that has more complex information and the risk of the information that is incorrect than for the companies that don't have that risk or have less of that risk. So what is the company that has a lot of inherent information risk to do? Well, one way for them to mitigate this problem is to hire a competent auditor who is going to assure the investors that, in fact, information that is being delivered to them is, in fact, good. Tied to that also is the whole notion of this business risk, right? Well, a business risk is faced by any firm. Any firm could fail to meet its stated business objectives. And the auditor's role when it comes to business risk is to assure that information related to future viability of the business is properly disclosed, that accounting is reflective of that business risk, that investors are well appraised of what's going on with the firm. As I already said, the auditing goes back to 17th, 18th century Britain, and followed by the formation of big firms in late 19th century. And auditing today, really, in the United States goes back to 1933 and 1934 SEC Acts, which stipulate the responsibility of auditors to audit annual financial statements of companies that report to Securities and Exchange Commission, and that would be publicly held firms. By the way, the term publicly held means, in this context, that the stock is traded on a stock exchange, for example, in New York Stock Exchange or NASDAQ, or even over the counter from broker to broker. That is juxtaposed to the privately held companies whose stocks are not traded on an exchange, and publicly held companies are required to report to the Securities and Exchange Commission on an annual and quarterly basis. Privately held companies are not required to do so. In fact, they don't do that at all. So how does then that lead us to define auditing in general? Auditing is a systemic process of objectively obtaining and evaluating evidence regarding assertions about economic actions and events to ascertain the degree of correspondence between the assertions and established criteria and communicating the results of to interested users. So what does that really mean? It's sort of a very long sentence, potentially hard to understand. What the sentence says is that in any financial reporting document, there are certain claims about the economic state of the company. In the balance sheet, there are implied statements that if the company has an account receivable balance, that those accounts receivable do indeed exist, and the company believes they'll be able to collect on them. If there's a line item about cash, likewise, the company believes that they assert, in fact, that's a term, that's assertion, that the cash is there, that's in the bank, that it truly is there. Or, for example, with respect to liabilities, the implied assertion is that the liabilities are truly there, that all liabilities that are truly there, in fact, have been properly disclosed. So when management provides financial statements, they make assertions about various kinds of things, about balance sheet items, about income statement items, about things that say in the disclosure and the footnotes, and so on. The auditing process is a systematic process of objectively ascertaining that, in fact, managers' assertions are true and can be believed. It just is, what characterizes the auditing in general, that it has this very systematic component dictated by the rules. So the key component of this class is that, we're going to learn about rules, how to audit. How do we go about ascertaining that the management did not lie to us? What do we need to do? What are the basic standards of care of ensuring that the financial statements as presented by management, and that is the term assertion, as asserted to by management, are in fact representative of the true economic reality that is out there. So the term assertions pertains to assertions about financial statements, including footnotes. Established criteria, in this particular case, pertains to GAAP, right? So we want to make sure that financial statements are prepared according to GAAP. Communicating the results pertains to the auditor reporting, that is telling the board of directors of a company formally whether in fact financial statements are good or not. Interested users in this case represent shareholders or creditors, as represented, shareholders being represented by the board. So, this diagram summarizes the process of financial statement auditing. So there's two parts to this diagram. One part of the diagram is that is right here. Management prepares financial statements. We'll talk about this a little bit more, but the ultimate responsibility to prepare financial statements is the responsibility of management. They are the ones who are generating the information. And when they generate this information, when they compile the balance sheet, when they compile the income statement, when they compile the statement of cash flows, when they write up the footnotes, they make claims implicit claims or explicit claims, namely we call them assertions. So those financial statements are subject of the auditor's check. Right? So the auditor is the objective third party, who comes in with expertise about the client, about knowledge, the knowledge of their business. They do various kinds of audit procedures. They observe their assets. They talk to management. They confirm the assets' existence and liabilities' existence and completeness. They inspect the documents. They do various kinds of procedures. We'll talk more about them in the course of the class. That allows them then to make an opinion whether financial statement assertions that management is making are in fact true. And what's their ultimate criteria to say something that's true or not? That is the GAAP and or IFRS. And once the auditor is satisfied whether in fact financial statements are true to the material degree, then they can issue an audit report giving the company a clean bill of health. All right, so here's the work product that the auditor delivers. So let's take a minute and talk about what we see in this auditor report. So the very first line says, the report of independent registered public accounting firm. So every word, by the way, in this report has meaning, and it has not just in simple economic meaning, it has legal meaning as well. So as we already talked about what independent means, right? Independent means that they're not, they don't have any conflicts of interests that would lead them to issue a report that somehow is biased. Registered. Now, this term only applies to publicly held companies in the United States. If you're a publicly held company in the United States, you are required to be audited by the audit firm registered with Public Companies Accounting Oversight Board. That is subject to oversight of that board. And they have to follow that board standards. If it was a report of a privately held entity, then they wouldn't necessarily have this term registered in there, because technically speaking, unless you are an auditor who just audits privately held, if you're an auditor that audits only privately held companies, you do not need to be registered with PCAOB. Public accounting firm. That's a term for an accounting firm that does audits. To the boards of directors and stockholders of Microsoft Corporation. Why do they address the report to board of directors? As you may know, board of directors is the ultimate representative of the stockholders, of the shareholders of a company. And they're the ones that ultimately the auditors report to and communicate with. Because Microsoft has so many different shareholders, well, it's very difficult to communicate with them all directly, so therefore there is a board of directors which represents the shareholders' interests. But the fact is, who is the ultimate employer of any auditor? It is the stockholders of the company, as represented by the board. Hence, the report is to both the board of directors and stockholders of Microsoft. We have audited the company and consolidated balance sheets of Microsoft and its subsidiaries. What does it mean we have audited? The word audited has a very specific meaning. It's different, for example, even in legal sense, from the word examined or reviewed, because audited implies that they gathered sufficient evidence to allow them to say that they've audited. And the point of this class, as we will be going through it throughout the semester, we'll learn what it means to have audited something, as opposed to have reviewed something, as opposed to have examined something. So auditing implies that there is a certain basic level of evidence that was gathered to allow to say that something was audited. Note the sentence highlighted in bold. These financial statements are the responsibilities of company's management. Who is ultimately responsible for preparation of the financial statement? It's not the auditor, it's the management. It's actually not a trivial thing in this situation. Why? Because lots of times, especially for those of you who will be working in public accounting firms that have lots of smaller clients, you will notice that you will have to help them with their accounting. You may sometimes be yourself involved in drafting of their financial statements. Well, as long as that help is not really material and not significant, that's okay. But at some point it becomes a problem. If the auditor starts acting as effectively the preparer of the financial statements, then they cannot technically audit their own work. Right? If you are also preparing the financial statements, you cannot then be that third party to just say that you are sure that those financial statements are in fact true. So otherwise, if your role is predominantly to prepare financial statements, then you're not the auditor, but you're not doing the audit, you're doing the compilation service. And so if the involvement and preparation of financial statements by the auditor becomes material, that in fact is the violation of the independent standards. We'll talk about that. And the auditor cannot, in that situation, technically express an opinion on financial statements. Next line. Our responsibility is to express an opinion on these financial statements based on our audits. So the ultimate goal of any audit is this document, this audit report. That's the auditor's work product, these 4 paragraphs that you're seeing. You're saying, oh, what's the big deal? It's all about the 4 paragraphs. Because what underlies the 4 paragraphs is a lot of work. The auditor cannot issue this report unless they really have done what they're supposed to. But ultimately, the auditor's work product is the expression of an opinion on the financial statements. We conducted our audits in accordance with the standards of the PCAOB. Well, it means that there are a certain set of rules that we followed in preparing those standards. What are those rules? In auditing. What are those rules? Well, those rules are rules of Public Companies Accounting Oversight Board. They have sets of rules that applies to auditors of public companies, and we followed them. That is our standard of care. That is how we ascertain that we followed the rules that we're supposed to do in conducting our audits, and have done our work well. Those standards require that we plan and perform the audit to obtain reasonable assurance about whether financial statements are free of material misstatement. What does it mean, reasonable assurance? Any audit, as you may know, as you may imagine, cannot involve checking of every transaction. Because the audits usually last maybe, for most companies, they only last a few weeks after the year end. In that short of period of time, it's impossible to check every transaction of a company. It's also impossible to check every transaction, even if the audit is to last the whole year. So, for example, for big corporations, auditors are on site all the time. But can you imagine how many transactions does General Motors have or General Electric have? It's very difficult. So the audits are not designed to provide what's called absolute assurance that there is nothing wrong. They're designed to provide reasonable assurance. And reasonable, it means it's more likely that they've done work that gives them a good sense that everything is fine, right? And what that means, reasonable assurance means, is that it's well defined by the auditing standards. Right? It's not a complete assurance. It's not absolute assurance. It's reasonable assurance. It does not mean that there is no chance that there's not something's wrong. It means that with some degree of reasonableness, auditors say, we looked at it and we've done our work, and we don't, we believe that there's nothing there. And that's what this free of material misstatement means. Now, free of material misstatement, material being the key word. What does material mean? It means that doesn't mean that that every single transaction is right. It's the significant things that are right. It's things that would sway the investor's judgment that they're right. Right? For a company with a sales of $100 million, a misrecorded sale of $10 doesn't really matter. But a misrecorded sale of $5 million matters. Right? So the word material in this context means that something is material when it could really affect somebody else's opinion about the company if it's incorrect. Our audit includes examining on a test basis evidence supporting amounts and disclosures in the financial statements. So the word examining is an important word here. It means that whenever you say you examine something, it means that you've gathered enough evidence to support that assertion to examine something, that in fact you went and checked to see that you can provide reasonable assurance about the financial statements are free of material misstatements. For example, just to contrast this word to the word, if it were to say the word reviewed, well, it has a very different meaning than the word examined. Reviewed means, well, we just went and looked at it, nothing appeared wrong, right? So if you say something that was reviewed, that's an example of what's called negative assurance. We're not saying nothing is wrong, we're saying that we didn't see anything to be wrong. Unlike here, we say we include examining on a test basis. We actually went and looked, and we can say positively that there's nothing there that is materially wrong, as opposed to if we were to say we went and looked and didn't see anything. That's a different sort of statement. So in this particular context, the word examine means we went, we follow auditing standards, we provide positive assurance that the financial statements are free of material misstatement. And finally, we believe that our audits provide a reasonable basis for our opinion, right? So we're making a statement that things that we did support our claim that financial statements are in fact free of material misstatement. Next paragraph. In our opinion, such consolidated financial statements present fairly in all material respects the financial statements of financial position of Microsoft and its subsidiaries, in conformity with accounting principles generally accepted in the United States. Again, this concept of materiality keeps coming back. We're not saying that every transaction is correct, but we believe that what we did suggests that the important things are right. And what does right mean? Right means in accordance to the US GAAP. Right? It doesn't say IFRS here. Here the audit was to ensure compliance with US GAAP. If it said IFRS, then it means that right in accordance to the IFRS. So the term right, it has to be given a frame of reference, and that is the accounting standards which we're following. Finally, the last paragraph, we've also audited in accordance with the standards of the PCAOB, company's internal control or financial reporting, and so on. And that means that in addition, as part of doing the regular audit, they also audited what's called internal controls and issued report on them. And we will talk more about internal controls throughout the semester. Signed, Deloitte & Touche, LLP, Seattle, Washington, July 26, 2012. Deloitte & Touche is one of the big four accounting firms in this country, and they do the audit of Microsoft. Now, what's interesting about the signature is that notice that it's signed in the name of the whole firm, as if the whole firm is responsible for the audit. And it's true, the whole firm is responsible for the audit. But behind this audit are very specific people. The audit partner, or the audit partners for this engagement, the audit managers, the audit staff, and so on. Not the whole firm did the audit, but the whole firm, at least in the United States, is responsible for it. So we talked a lot about audits. Audits, the concept of auditing pertains very closely to very specific things which are required to report on financial statements of companies. But you can also have a more narrow engagement to check something else. For instance, it would be the term for those is attestation engagement. So, for example, you may hire an audit firm to ascertain that financial projections which they are providing and its forecasts are reasonable, right? It's a very different sort of an engagement than doing an audit. So, broadly speaking, an attestation engagement is where a practitioner assesses and reports on subject matter, on assertion about the subject matter that's the responsibility of another party. So it's a much a broader term. You can sort of fit the audit within that definition as well, although we tend to think of audits as something more specific and very different. So as opposed to having to follow GAS here and having to make sure that financial statements are in compliance with GAAP, it becomes much more subject specific. Attestation engagements, like I already said, could involve commenting on reasonableness of financial forecasts and projections, examining MD&A, looking at pro forma information, examining non-financial attestation engagements. So look at just internal controls, look compliance with environmental regulations. But all of those have one unifying characteristic to them, And the management makes a claim, namely an assertion, that our environmental protection is good, and the auditor comes in and does the work to ascertain that this assertion is correct. So this slide talks about various kinds of examples of attestation engagements. So I already talked about ensuring that financial forecasts and projections are reasonable. I used to work on the back in the day on something called agreed upon procedure on the special compliance audit of Verizon Wireless. By the way, I use the term agreed upon procedure. Agreed upon procedure is a term that is often applied to attestation engagements. And basically, what's agreed upon procedure, the auditor and the client agree upon what the auditor is to audit effectively in that situation, as auditor is to attest to be precise. Right? So in that particular case, the client wanted an opinion on reasonableness of the report they were required to provide to a regulator. And they had to hire an auditor to say that what the client was saying is true. And we see that quite often in where accounting firms they get hired to attest to provide attestation on various kinds of things beyond simple financial audits. That ties to sort of the broad concept of assurance services. And so assurance services as a whole, it's a very generic term that encompasses auditing services, encompasses attestation services. So, you can look at things like XBRL reporting and making sure that the company XBRL reports are right, green reporting is right. The company might be saying, oh, we are not really meeting all this greenhouse gases. And so the auditor might have to come in and attest to whether the fact is true or not. So that falls into all this broad umbrella of assurance services, as this diagram illustrates. So the auditing refers to a rather narrow definition of just providing an opinion on financial statements in the company. By the way, if you look at the Form 10-K of a company, that is the annual report of any firm, it will be rather long. So what's interesting is that the auditors do not provide an audit opinion on the whole thing in the Form 10-K. All they provide an opinion on is just the financial statements. Lots of times, financial statements that are included in the Form 10-K may represent maybe 1/3 of that whole report. There's also a bunch of other things in there, like, for example, management discussion and analysis, the letter to the shareholders, and so on. Those things, the auditor has nothing to say about. It's just, that's basically just the management speaking to the client. Auditor's responsibility when it comes to audits extends only to the audited financial statements. Now, an auditor could be hired to attest to the assertions related to other types of financial information, for example, financial statement projections. So in that case, he performs an attestation service. Or they may be hired to do things that extend beyond that. So, for example, I told you that I was working on this engagement that looked at the report of the regulator, right, on information that was not unrelated to accounting at all. And that's an example of an assurance service that the auditor may provide. Okay, so this sort of broadly is defined for us what auditing is about. Probably the most important law that was passed in the last 10 or so years that affected auditors was Sarbanes-Oxley Act. As you may know, Sarbanes-Oxley Act was passed in response to the big accounting scandals of the early 2000s, mainly Enron and WorldCom and some others, which really shook investor confidence in capital markets and in the auditing profession in general. As you probably know, Arthur Andersen, which was Enron's auditor at the time, ended up going bankrupt effectively and folding. This was one of the 5 firms at the time, which were biggest in the world, because they were found criminally liable for botched audits of Arthur Andersen. So, after all this catastrophe of early 2000s, 2002, 2003, the Congress passed a law called Sarbanes-Oxley Act. Sarbanes was the representative, actually, of the state of Maryland, um, who helped draft this legislation. Sarbanes and Oxley are two members of Congress. Sarbanes was the member of the House of Representatives. Oxley was the Senate member of the Senate. So they drafted this law. And the law has a number of provisions. One of the most important ones are Section 302, which requires that a CEO and the CFO of a company certify that they're responsible for financial statements. Now, you would think, what a silly provision. Why do we have it there? Well, guess what? In the early 2000s, as the scandals were unfolding, some CEOs were claiming they had no idea that accounting was wrong. For example, the CEO of Enron was claiming that he had no idea that his company's financials were fraudulent, that the CFO did it all. So obviously it didn't get them very far in trying to defend themselves like that. However, the law decided to, the Congress decided that we're going to put this in the law, that the CEO cannot ever claim that they don't know any accounting. It doesn't matter if they know accounting or not, they're still responsible. And they can be held criminally liable if the accounting is wrong. Among some other things that Sarbanes-Oxley had passed at the time were prohibition of various kinds of non-audit services that the auditors could no longer provide. And the reason was that before Sarbanes-Oxley, auditors did a bunch of other things for the clients. All public accounting firms had very big consulting practices, and which were involved in various kinds of things unrelated to audits at all. So, for example, they would, help companies with their computer systems. They would help companies with their human resources systems. And many people have said that audits were effectively just the way for Big 5 firms at the time to lure the clients to sell them this highly lucrative consulting services. That many people argue that wasn't the case, but nonetheless, basically, many people would say that ability to sell this consulting services impaired negatively auditors' ability to be objective. So this was like a form of a bribe from a client to an auditor. So Congress went ahead and prohibited those non-audit services. So that was the sort of the most significant provisions of Sarbanes-Oxley Act, and as it relates to auditing. So I already mentioned the word assertion. So that so what are those assertions that the management is making whenever they effectively present financial statements to be audited? First one is existence or occurrence. Whenever the management presents financial statements, for example, balance sheet, to the auditors, they're effectively asserting that whatever is on that balance sheet truly exists. You can think of an assertion of existence in terms of a risk, that in fact that something is posed as existing may not in fact exist, right? So management says, this cash balance is $1 million. What does the auditor care about? They care about whether, in fact, what is the risk in management is in fact lying in their assertion. What is the risk that this cash balance doesn't exist? So the auditor then has to design audit procedures to ensure that they're comfortable that, in fact, the management assertion of existence about this cash account is in fact true. And assertion of existence is most important for assets, right? We care about assets' existence, whether in fact cash balance is in fact there, whether in fact accounts receivable balance is in fact there. It's most important in terms of revenues. Has the company really made revenues that it claims it did? So that's a key element, key risk for testing for existence is a key risk for auditors and testing of assets. Rights and obligations. The management says that the cash balance is $1 million. Do they own that cash balance? Or has it been pledged maybe as a collateral to something, for a loan that they have? They have, in other words, the entity has a legal claim on all assets and revenues reported and has a legal responsibility for liabilities and expenses. They, in fact, you can think of it as a concept of a title that exists in law. Do they have the title to those assets? Or somebody else has the title or a claim on those assets? And if so, has it been properly disclosed? Completeness. Is everything that's out there economically about the firm, in fact, being shown to the full extent on the financial statements? That's an assertion most important for liabilities, because it tends to be that management may not want to show all liabilities. So, for example, do they show all accounts payable that they in fact have on the balance sheet? Right. So the risk of the risk of lack of completeness, if you will, pertains to liabilities. So therefore, when auditors design their procedures, when it comes to assets, their focus is on existence of assets. When it comes to liabilities, their focus is on completeness of liabilities. It's not to say that auditors don't care about complete existence of liabilities. They do, but they always have to, you cannot test every assertion equally, because you'll never finish the audit. So you focus on the risk. The risk of the liabilities, the incentive that the management has with liabilities, is to, in fact, not record all liabilities. Yeah, the management sometimes has an incentive to record too much liability, but it's less of a concern for the auditor, because the auditor is mainly concerned with understatement of liabilities, not with overstatement of liabilities. Valuation or allocation. In fact, does the value of this account receivable, is it really truly what the value is that the management is claiming? Is there enough of an account receivable allowance out there to cover all bad debts? Is the security been appropriately marked to market? Management, when they furnish the financial statements to the auditor, they make that implicit claim. The auditor then has to go back and audit to ensure that this assertion, this claim, is correct. Presentation and disclosure. Are the financial statements correctly presented? Are all footnotes that they have to be there, are they complete? Do they provide information that the investors want? So ultimately, these 5 assertions in some ways are the core of how you do the audit. Right? So when the auditor tries to design an audit program, right? When they try to design an audit plan, ultimately what they think about are the 5 assertions as it pertains to different areas that they're going to audit. And then they tend to think of it in terms of what is the higher risk for every area that they're going to audit. So for example, for assets, as I already told you, the risk is mainly of overstatement. The risk is the fact that the management says that they exist and they really truly don't. When it comes to cash, does this cash really truly exist? When it comes to receivables, are these receivables collectible? Do they truly exist? Are they phony? And so, every audit area, every audit program is designed with these 5 assertions in mind. You have to test all 5 assertions in every area. In liabilities and assets and equity, you have to test all 5 of them. But the focus changes from area to area, because I already told you, in liabilities, completeness is a greater concern than existence, and vice versa in assets. So any audit involves in some ways a trade-off between what's going to be our focus, what is the greatest risk here. So the audit, we'll talk a lot more about that later, but fundamentally every audit involves it's a risk-based concept, where we audit for on the basis where we perceive the misstatements might be. And in assets, it's when the assets are more likely to be, the risk is with overstatement, the liabilities, the risk is with understatement. These assertions are pretty much very similar under the PCAOB standards and under the Auditing Standards Board standards. Auditing Standards Board is the branch of the American Institute of CPAs that originally developed the auditing standards before PCAOB came about. I didn't mention this, as a result of the Sarbanes-Oxley Act. Sarbanes-Oxley Act mandated the PCAOB be created. Before that, we only had auditing standards as passed by the Auditing Standards Board. So initially, PCAOB adopted all of the auditing standards by the Auditing Standards Board, and over time developed its own, which are basically either they've added certain things or slightly modified the Auditing Standards Board standards. And so those assertions are occurrence, which is basically existence, completeness and count off. Completeness meaning, we already talked about it, that everything that's out there shows up economically is actually on the balance sheet and income statement. Cutoff means that the procedure, that the transactions are reported in proper period. It's closely related to completeness. So for instance, there it means that if you're showing something as an expense, it is truly expense of that period, not of the next period, not of the prior period, and so on. Accuracy, that means that that everything is correct. There's no mathematical mistakes. The transactions are all reflected correctly. And classification refers to the you want to make sure the proper accounts are used. Existence is the same standard under the ASB standards, rights and obligations as well. The same completeness, the same inaccuracy and valuation refers to, again, the valuation, making sure that your account balances are in fact reflective of what they're truly worth. So this little diagram sort of summarizes how the audits are done, right? So, broadly speaking, when the audits are done, audit team audits by area. So, for example, they may start with auditing cash and assets and current assets. And then they move on to current liabilities and non-current liabilities. And every member of the audit team tends to do one part of the audit. The audit program, the audit plan is written differently for every area. Again, like I said, already on the basis of the risks. So, as I already mentioned, so for example, for cash, occurrence or existence is a more important risk. So they will focus the audit of cash account on existence. They'll send the confirmation of cash balances to the bank. They'll look at the bank statement. They'll test bank reconciliation to make sure that everything there is correct. If they test accounts receivable, the focus will be again on existence. Do these accounts receivable exist? Are they phony? They will issue what's called confirmations of those receivables. They'll effectively send letters to the customers who owe those receivables to confirm that the balance is right, and so on. So you go area by area, you go account by account, and the goal is to audit the whole balance sheet from period to period. And then you, as part of auditing the balance sheet, you audit the income statement as well, because what is income statement? Ultimately, it's just the reflection of the change in accounts balances in the balance sheet, right? You get that assurance that everything is right on the income statement by auditing the balance sheet, and to the extent that you audit the balance sheet, you also audit income statement accounts. So in the end of the day, the audit is done on every account is audited, and you got comfort with every account that is audited. So that's what this diagram summarizes. Now, the key integral concept of how to conduct an audit is this notion of professional skepticism. It refers to how the auditor is to hold themselves when they do an audit. How are they to behave? Are they to not trust every word management is saying? Are they to be behaving like a detective, which is skeptical very strongly about everything that they say, don't believe a word that they say? Are they to treat management as liars, with the expectation that they've been lied to? What are they to believe every word the management is saying? That everyone is internally good and they're never really going to lie to us. What they're saying is true. So I guess the answer is, as everything in life, the truth is somewhere in the middle. So this notion of professional skepticism is this idea that you have a questioning mindset towards representation made by management and evidential matter gathered. In other words, you don't treat the management as a liar. Ultimately, the absolute majority of company CEOs and CFOs and employees are true, are honest, law-abiding people, and they don't have an incentive to lie to you, right? So you don't treat them as criminals. You don't treat them. You treat them with respect, and you do not play a role of a police detective. However, at the same time, you're also ask questions. You also see, does this make sense? You don't come with the expectation that nothing's wrong. You are sort of somewhat healthily skeptical. Hence the notion of this professional skepticism. Um, Ultimately, the reason is because you cannot always believe the client, because there's always some sort of a bad apple right out there, and your goal is to catch the bad apple, and your goal at the same time is not to alienate good people. So you want to be skeptical in the sense that you want to have a question in mind. You don't necessarily take everything at the face value. It has to make sense. And if something doesn't make sense, you don't just leave it over there. You actually investigate, and you get the comfort that you need to say, yes, I agree with it or I disagree with it. So let's talk now about a little bit just about the organization of kinds of services that public accounting profession provides. So we already talked about, broadly about this whole notion of assurance services, and what falls under that umbrella is the financial statement audits, assurance engagement, attestation engagements, compilations, and reviews. I already mentioned compilations a little bit. Compilations are, situations when the public accountants are engaged, in fact, to prepare financial statements of a firm, from either existing records, or they have to sometimes actually compile records. Reviews are similar to audits in the sense that they provide assurance. However, as opposed to audits and attestation, which provide what's called positive assurance. In other words, auditors basically say, we believe that this is good. We believe that these financial statements are good. Reviews provide negative assurance. In the sense that reviews involve much lower level of looking at evidence, and basically seeing, do you notice anything problematic, right? If you notice anything problematic, you act upon it. So that's the kind of negative assurance. And in fact, review report will read, we did not observe anything wrong, as opposed to everything is good. The fact that you didn't observe something wrong doesn't mean that there's nothing wrong. It means that you just didn't notice anything. So it's a lower level of assurance. It's a lower level of liability for the auditors for a review engagement may not be right. But sometimes the companies don't want to pay. The audits are expensive. They could run up millions of dollars, and especially if you're a small firm and you need something done for your bank in terms of your financial statements, the bank might not want a fully blown audit. They may just want a review. So in which case, it's much less work on the part of the auditors. So it's a lot cheaper. So therefore, especially smaller public accounting firms, regional and small firms tend to provide them quite a bit. Public accounting firms also are quite often engaged in tax services, right? So they prepare their clients' tax returns, whether individual or corporate or trusts and estates. And as already mentioned, public accounting firms, at least many of them, have consulting divisions, which are there to assist their clients in other matters, whether it be implementation of computer systems, human resource management, what have you. Now, the important part is that you're not allowed to, the audit firms are not allowed to provide consulting firm services to the clients that they audit. So, generally speaking, those consulting services and advisory services are for clients that do not get audited by the same firm. And this is the diagram, of an organizational chart, if you will, of the typical public accounting firm. And you may see in charge of any audit is the audit partner, and the audit partner is one of the owners of the audit firm. They have actually equity interest in the audit firm. Because they have this equity interest, they ultimately also have the ultimate liability for bad audits, for botched up audits. They can be sued, and their cows can be taken away if in fact the audit is bad. And managers are the next line of people that manage audit engagements. They're at this point already employees of partners. They don't have any equity in the company, in the audit firm. And below them are the senior in charge accountants who run audits on a day-to-day basis out in the field. And below them are people like you're going to be when you graduate. And you'll work work as people that actually do the grunt work. So this is the organizational chart. That's how the services are run in public accounting firms. Broadly speaking, just so that we have a sense, there's four types of audit firms. Up on the top are Big Four accounting firms: Deloitte, Ernst & Young, KPMG, and PwC. They together control about 95% of audits of publicly held companies in the United States. And then they have the national firms, which are actually a lot smaller than any of the Big Four accounting firms, but they're still large. They have offices across the United States. The Big Four firms are really truly international. They have offices all over the world. National firms have offices across the United States and may sometimes have international offices as well. The focus of national firms is on different type of clients. They will audit some publicly held entities, but generally speaking, they're much more into the middle market, so-called middle market, smaller companies that are of less interest potential to Big Four firms. And ultimately, you have the local, regional firms that serve, so the community needs, if you will. They will do audits of small corporations. They'll do a lot of individual tax return work, and so on. And ultimately, it is the sole proprietor. They might also do audits sometimes. That's much more of a rarity these days. Sole proprietors don't really do audits because there's a lot of fixed costs involved in an audit. And also, potentially, remember that sole proprietor, just as an audit partner, would be personally liable for a bad audit. So liability insurance is what you have to buy to protect yourself against lawsuits in that situation. It's very expensive for a sole proprietor who does audits to carry it. So, sole proprietors these days focus much more on, if they do audits, it would be very small entities that are low risk. But mainly it's much more about tax work and about other types of things, trust in the states and so on. This slide gives you a sense of how much money the public accounting firms make, what is their revenue mix. As you can see, the biggest provider of audit services is PwC. They hold together about 50% of the the revenue comes from audit services, and they are the largest purveyor of the audit services in the world for publicly held firms. I already mentioned that Sarbanes-Oxley Act prohibits auditors from performance of certain consulting services, and this slide gives you a sense of what those consulting services are: the bookkeeping, design and implementation of financial information, actuarial appraisal valuation services, internal audit outsourcing, management, human resource services, and so on. Now, you can perform those services to a client, but you just cannot audit the same client. So therefore, many public accounting firms have consulting divisions. They just don't do the consulting work for the clients that they audit. Tax services is also an integral part of any public accounting firm. And they do provide client services, tax services to the audit clients as well, but it has to be done with the approval of the audit committee. It's actually fairly important because tax divisions and audit divisions of public accounting firms work closely together when it comes to auditing tax accounts of a company, right? So yeah, that's the reason why the tax services were not prohibited, because sometimes ability to provide tax services is integral to conduct of an audit in general. So briefly, I want to talk about different kinds of auditors. We, in this class and in this lecture, predominantly focus on financial external auditors. These are the CPAs who provide assurance, positive assurance that financial statements are reliable. There's also other kinds of auditors. For example, many companies will have what's called internal auditors, and those are the people that basically help management to check various kinds of things. Whatever they want to decide, they will conduct audits of operational efficiency, things being done right, can we do them better. They can also assist external auditors in audits. So internal auditors are people, many of them have accounting background, sometimes not, that are out there that report to the upper management to ensure that things in the corporation are done correctly. And they're very important, actually. Very often they catch, if there's a serious fraud going on, they're a very first line of defense. Example of that would be WorldCom, right? Where the WorldCom fraud was caught by the internal auditor. And there's also different kinds of compliance auditors. Those are the people that ensure that companies comply with government and internal regulations. So IRS auditor would be an example of that. And there's also forensic auditors, and these are really, they're external investigators of fraud and so on. So they are the ones that, if they're called upon to a company, if there's an investigation of a fraud, they really act like detectives. So there's really not really, they could be viewed of, and many of them actually do end up working in FBI and places like that eventually. So obviously the point of this class as a whole is to ensure that you guys, we want you to become CPAs, we want you to become good accountants. So you're on the first step to getting your CPA license, getting your 150 hours to be able to be licensed to sit for the exam. We all hope that you sit for the CPA test, CPA exam, and pass it. Once you do that, you become certified, and certified means that just you pass the exam. Every state has different rules when it comes to licensure as a CPA. To work as a CPA, you have to be licensed. Generally speaking, it involves some sort of an experience requirement. For example, when I got my CPA in 1999 in Minnesota, I still had to work for 2 years after that to become licensed as a CPA, because in Minnesota there's a specific work requirement of auditing for 2 years in public accounting. But the experience requirement is different from state to state. For example, in Maryland, as far as I know, it's much less strict. And you don't just need to do public accounting. They will count various kinds of other experience, as long as, let's say, you are supervised by the CPA. So, you check the laws, local state of the local state, the state of Maryland or DC or wherever else you live in, Pennsylvania. And so ultimately, once you fulfill your experience and examination and education requirements, you become a CPA. You get a certificate, you have to get a license, you have to maintain requirements to maintain this license. For example, continuing professional education, cannot do anything bad that would lead to your license being taken away. So you have to maintain, have to comply with professional standards, be an ethical person, and so on. And ultimately, that we believe is your goal. It should be your goal if you're in this program, and that's your goal in a successful career. So today's CPA exam looks very different than it did when I took it 13 years ago. It's the same in that it has still four parts: auditing, financial accounting, and regulation and business environmental concepts. Back in the day, the structure was slightly different. You still had auditing and financial reporting, and what now is called regulation used to be called law, and tax and managerial accounting were the other part. The big difference today is that under the old rules, the exam was only conducted twice a year. Everybody had to go in and take it simultaneously, and had to wait a few months to find the results. Today, you can take one part at a time. You're given 2 years to pass all 4 parts. So today, the exam is much more user-friendly. It's a computerized exam. Today wasn't computerized, at least entirely when I took it. And it's a mix of multiple choice and simulation questions that are there to test your knowledge of everything we study. Broadly speaking, you can think of, we talked about the structure of various kinds of accounting firms. There's also professional organization of auditing profession. I already mentioned the American Institute of CPAs, which is a fraternity organization of certified public accountants. It does various kinds of things. One of them is develop auditing standards for auditors. They also develop independent standards. They provide a bunch of other certifications. For example, if you ever become interested in forensic accounting, they have a certification in forensic accounting. If you ever become interested in valuation services, they have certification for valuation services. They provide continuing professional education, courses, and so on for the CPAs. There's also state CPA societies. These are fraternal organizations in every state. Closely related to them are the state boards of accountancies, which actually administer CPA designation in every state. Another organization that actually is a fraternal organization of internal auditors is the Institute of Internal Auditors, and they deal with standards as it relates to internal auditors. Besides the CPA, there's others. There's other professional designations which reflect your standing and knowledge and level in the career that you may be pursuing. Certified fraud examiner is one of them. So a certified fraud examiner is somebody who is involved in forensic accounting and passed the knowledge on actually to maintain, required to claim that you are a good, you could be good in looking for fraud. Certified internal auditor, again, it relates to standards as it pertains to internal auditing. Designation, CISA, Certified Information System Auditor. These are auditors of computer systems. So basic designation that maintains you have a level of skill expected in that field is given by ISACA, which is Information Systems Auditing and Control Association. So ultimately, who audits the auditor? For public companies, I already mentioned that is Public Companies Accounting Oversight Board and Securities and Exchange Commission. PCAOB, Public Companies Accounting Oversight Board, actually reports to the Securities and Exchange Commission. Both can punish you for bad behavior. If you're a bad auditor, they both can come after you. If you are not an auditor of publicly held entity, then you follow ASCPA standards, and ASCPA has a peer review program where audit firms get reviewed by other audit firms to ensure quality control. And ultimately, state boards of accountancy, through the maintaining of the CPA license, programs are responsible for monitoring conduct of individual auditors. They can have your license taken away, they can have you fined, they can have you do bad, they can put your name in a newsletter for bad behavior.